raised an excellent question, which is the prospect for tax reform. And keep three numbers in mind, Morgan. If you take our earnings model and you assume for a moment the current tax law would to be applied to 2022, next year's earnings, you look around 12% earnings growth. We assume that there's going to be an increase in tax rates, and therefore we're looking around 9% earnings growth. And the third number to think about was a full application of the proposal by the Biden administration would lead to earnings growth next year of around 2%. So 2%, 9%, 12%. Somewhere in that range is likely to be where the earnings growth ends up being for the market in 2022. And make no mistake about it, all of the conversations with clients now are about the prospects for profits in 2022. Unfortunately, lots of time, as the president just said in the clip you played, remains to be negotiated exactly what the specifics will be, and they will matter, whether it's more on the GILTI and the international exposure or whether the statutory rate, all those things. But it is a big focus of portfolio managers. And in fact, the idea of trading this is probably a little too early because the specifics do matter.
Yeah, I mean, I realize there's a lot in flux. You just said it, trading this. Still a little early, but just looking at your price targets over the coming months, coming 12 months, is it safe to say that you're probably or could potentially be bringing those down depending on the details?
Well, the risk to our earnings, I would estimate, is probably to the downside as opposed to the upside. Yeah. We are assuming in our forecast that the statutory rate rises, say, to around 25%. The risk, of course, could be higher. Could also be lower, but the baseline risk would probably be to the upside on tax rate, therefore downside on earnings. I think the three big issues, taxes are one, margins are the second, and the third is interest rates. And over the last month, really year to year, over the course of the last couple of months, those discussions with clients have shifted in terms of the prioritization of topics. Well, right now we start in a big way kicking off the first quarter earnings season next week, and the pivot will be to margins. We know there's been a lot of increases in supply chain, prices have been rising. And the question really, how much and which companies, which industries will be pushing through increased prices to their consumers, if you will, ultimately to the individual consumer, and therefore has some implications on broader inflationary trends. That's going to be the topic that most fund managers, investors will focus on with management on their conference calls. And to think about this, year-over-year growth in the first quarter will probably look something in the vicinity of 20% at the aggregate level. Median stock, which is probably more relevant for stock pickers, is around 9%. So 9% year-over-year growth in earnings is what people are expecting as you come into the quarter. That's not going to be that relevant. The last couple of quarters, Morgan, no one really paid for any positive surprises. Really what they're focusing on is the forward. What's the likelihood? You saw Kimberly-Clark just announced earlier, I think last week, that they were going to be raising prices on their goods between sort of mid to high single digits. You're seeing other companies make these announcements well, that's a question of how durable are the margins likely to be, who has pricing power, who doesn't. So I think that's the pivot. For a while was on rates. Then it pivoted to taxes, which was kind of the last couple of weeks. We've been focusing on that. And now I think it's going to, at least for near term, going to focus on margins and pricing power.
Shepard Smith here. Thanks for watching CNBC on YouTube.